Hello and welcome to The Eighth Wonder, a channel dedicated to making compound interest your best interest. There's a popular saying attributed to one of the founding fathers of the United States, Benjamin Franklin, which says that in this world, nothing is certain except death and taxes. While I cannot tell you how to avoid death, I can tell you of one legal way of avoiding taxes on your investments. This is through something called a tax-free savings account. What is it and how does it work? Well, I'm glad you asked. A tax-free savings account, or TFSA for short, can be a money market or fixed-term bank account, a unit trust investment, a JSE-listed exchange-traded fund, and more. It guarantees your capital investment and is an effective way to save for your long-term future goals because any interest, dividend, or capital gains will be tax-free. Since a lot of people are not very good at saving and investing their money, the National Treasury came up with this type of investment vehicle as a way to incentivize saving among South Africans. It has been available since the 1st of March 2015 and has had a few adjustments. A tax-free savings account allows you to save a maximum of 36,000 Rand per financial year, meaning between March of this year and February of the following year, and a maximum of 500,000 lifetime. This means that an individual can invest a total of 500,000 Rand at increments of 36,000 Rand per year, which can grow without any tax being charged. Those two limits do not include the profits that you make on your investments. For example, if a person invested 36,000 Rand during the financial year of assessment and the return on investment is an interest of 5,000 Rand, which is capitalized, the total amount in the account will be 41,000 Rand. The interest amount of 5,000 is not regarded as a contribution. The same applies to the 500,000 lifetime contribution. It is important to note that any withdrawal made from your tax-free savings account is deducted from your lifetime contribution. For instance, if you have contributed a total of 300,000 Rand towards your tax-free savings account and withdraw 50,000 Rand, you will still only have 200,000 lifetime contribution available to you. In other words, you can top up your tax-free savings account again after a withdrawal, and any withdrawal will result in you forfeiting your tax benefits, while at the same time wasting part of your lifetime contribution and losing out on potential investment returns. Essentially, this is meant to be a long-term investment and should therefore be used as such. Now, with the limits set in place, if you want to max out your lifetime contributions as fast as possible, it would take you a total of 14 years or 167 months depending on the strategy you employ. If you can afford to, you can throw 36,000 Rand into it at one go every year for 13 years and then 32,000 Rand on the 14th year, or you could dollar cost average 3,000 Rand every month for 166 months and then have a final contribution of 2,000 Rand on the 167th month. While we're on the topic of contributions, the limits are very strict. If you contribute anything more than the stipulated amounts, the excess will be taxed at a rate of 40%. So if you contributed 40,000 Rand in 1 year instead of 36,000, you'll be liable to pay a 1,600 Rand tax penalty, which would be charged on the extra 4,000 Rand you would have contributed. Another important thing along with this is that any portion of unused annual limits is forfeited. That is, it is not carried forward to the subsequent year of assessment. So if you only contributed 27,000 Rand this year, you can't contribute 45,000 Rand the following year. If you do so, your extra 9,000 Rand will get taxed. So where do you go to get started on your tax-free savings account? Well, most banks and financial institutions offer these services, which will come with some management fees. A quick Google search will help you know whether or not the institution you have in mind offers these services. As you probably already know, my recommendation is to be hands-on with your investments so that you can learn how they work. That being said, it is your choice to make on whether or not you would like to take this approach. For those who want to be hands-on, Easy Equities offers these services. The link to it is in the description box below if you'd like to sign up and get a 50 Rand bonus to get you started. As I mentioned earlier, you can invest in JSE listed exchange traded funds, which are all available on the Easy Equities platform, tracking all sorts of different industries and businesses. Along with ETFs, there are unit trusts, baskets, and bundles, which are alternatives you can invest in, all of which offer exposure to different parts of the market and varying amounts of risk to suit your appetite. Anyone who has an ID number can have a tax-free savings account of their own, so parents can start saving for their children's tertiary education as soon as their child is born. And since it takes 14 years to max out, and the child would, in most cases, only start tertiary at 18 years, that's an extra 4 years of compound interest that can be earned. The only disadvantage, if you want to call it that, is that whatever amount is contributed to the child's account forms part of their lifetime limit. But I don't think anyone would complain about getting 500,000 plus to get them started on life. A couple can easily save R1,000,000 between the two of them by both opening up their own individual accounts and maxing out their contributions. It is possible to have more than one tax-free savings account, but the limits will apply to both accounts combined. Your 36,000 Rand will still hold and can be spread between 2 or more accounts. It is also possible to transfer funds from one account to another, but such a transfer can only be made between service providers. You should not withdraw your funds from one tax-free savings account and then deposit them into a new tax-free savings account. Such an action will be viewed as a withdrawal, and any reinvestment would then count towards your lifetime allowance. The beauty of investing in exchange-traded funds is that you can earn dividends that you can then reinvest into the holding. By so doing, you will increase the rate of your returns, which over time makes a big difference. You can even set your dividends to automatically reinvest so you don't have to think about it. There is no telling as to how much you can make through a tax-free savings account, but one thing you can be assured of is that whatever amount it is, in the end, it is 100% yours to use towards whatever you decide. Even though no tax is payable on your earnings within a tax-free savings account, as a South African tax resident, you are required to disclose all investment information to SARS when submitting your annual tax return, including certificates issued for income within your tax-free savings account. With that being said, what are you waiting for? Go ahead and start taking advantage of this great investment tool and start saving towards your future. Don't forget to use the link in the description to sign up for Easy Equities, and while you're at it, subscribe to the channel and click on the notification bell so you are notified of the next video upload. Leave a like on the video and share it with a friend so they can also learn about all these great benefits discussed today. Thanks for watching. Hope to see you on the next video. Until then, stay invested.